Hello, I'm Greg Vanel. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights, help boost your trading potential. Coming up, investors are sifting through a wave of earnings reports, keeping a close eye on U.S. trade talks with some key partners. Plus, tech earnings taking center stage this week. Alphabet and Tesla set to report after the bell on Wednesday. So we're going to look under the hood of the NASDAQ 100, break down the technicals behind the recent market action. And it's the burrito battle you didn't know you needed. The bull versus bear debate on Chipotle. Insights and option strategies are on the menu. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Closing at a new high in yesterday's session, the S&P 500 under some modest pressure today. As we said, crush of earnings, trying to figure out as we get closer to August 1st what all these trade talks could amount to. It's not a major pullback considering we just hit a new all-time high yesterday, but a bit of a pause in the rally. Let's jump into the heat map and see what is pulling us back from that all-time high. The first blush here seems to tell me a bit of a tech story, particularly when it comes to Nvidia, down about 3%, Meta and Amazon and Google all down modestly, but it's definitely not helping us move into the green. As we said, crush of earnings. Let's get into General Motors. An interesting one here. The profit line taking a $1 billion hit from tariffs. Profit booked for the 3 months, $1.9 billion compared to last year when it was almost $3 billion. GM says it's going to invest $4 billion, lots of billions, to shift more production to the United States. This is, of course, the aim of the tariff policy that is hitting their bottom line. Just yesterday, their rival Stellantis warned of a $2.7 billion loss for the first half of 2025, tariffs being a part of that mix. You can see GM shares right now under significant pressure in the early going. Let's check in on Coca-Cola as well. I feel like the stock's trying to find which direction to go in. It did top Wall Street's estimates for its quarterly earnings and revenue, but you start looking at the picture. There was growth in Europe and the Middle East. That offset weakness here in North America, also in some of the Asian markets for them. They are, however, standing by their full year revenue forecast for growth, but they're just narrowing. You know, when they give you that range of what the earnings per share are going to look like on the bottom line, they're just narrowing the top end a little bit. So as we said, the stock just seems to be bouncing around right now in the early going as investors sift through it all. And that's your market update. Now, for more technical take on what is happening in the markets are our panelists here in the meet. Jason, I don't know. I was going to coin a new phrase for you guys, and it's like, we'll go with panelists again this week. Here in the meet, Jason from our direct investing educational team.
Mucho, El Libre, anything for today's theme.
We're going to work on some nicknames. We're workshop some stuff. Obviously, the markets yesterday, the NASDAQ, the S&P 500 closing at new all-time highs. You're taking a look at the NASDAQ 100.
Yeah, let's unpack that, Greg. So NDX is the symbol that we've got on the charts. This represents the NASDAQ 100. Of course, for those uninitiated, this is the 100 largest non-financial companies listed on the NASDAQ. And Monday, or yesterday's close, in fact, it hit a record. It marked the 61st straight trading session, which it closed above its 20-day moving average. Now, on the charts, we've actually got that mapped out. So this yellow line right here represents that 20-day moving average. Now, it hasn't done this since early 1999. And at that time, the record is at 77 straight days of closes above the 20-day moving average. It was about a year later when all of that sort of unwinded and we saw the collapse happen. So we're seeing a lot of strength coming into this earnings. This also second quarter earnings season well underway. Financials just cleared up. We've got now the tech starting with, in fact, tomorrow. The two out of the Magnificent Seven will go out of the gates. Google and Tesla are going to be reporting. Now, interestingly, I wanted to also peel back and see what is the consensus earnings growth coming out of Q1 and now into the Q2 season. That currently stands at 17.7% for the IT sector, information technology, which is what we're focused on. It is down from 18.1, which is what the first quarter had done. And then for the full year consensus, we're at 16.9 for tech earnings growth. That's going to be down from 21.5% in 2024 there. The big things I think for most traders to watch coming to these charts is a lot of these tech companies will be cloud growth. We're going to hear more about that, specifically from Google, AWS, Amazon, Microsoft. AI spending. Hyperscalers announced that the first quarter they were going to be doing big spending, what that means, and then the US dollar weakness is probably going to play into favor. With a lot of these tech companies having exposure internationally with the dollar so low, what can that mean for their bottom line? Here's what the charts are also showing. So we talked about the 20-day moving average staying right above it. It actually broke above this key resistance zone that I've marked. And I want to mark this as a key because if any faltering with this highs that we have now, we could see profit taking happening and we could see potentially the index peeling back into this layer, which is around that 22,000 mark. Now, it has been tested 3 times before at the start of this year and rejected off of that level. It did have the kind of the move to go in, but I'm not really seeing a lot of conviction with the candles. They're not really big candles pushing into this. So this is a key test will be first the 23 zone. If it can hold that line, it is at the bottom end of the ascending channel as well. So break through that would mean it could go back into this resistance. What was resistance zone will now be potentially support zone going into the next couple of weeks here.
All right, you mentioned the role that a lower U.S. dollar could play in some corporate earnings, also playing a bit of a role in the gold trade, I imagine.
It is, absolutely. So I've got the gold charts pulled up over here. So we've got the futures, the gold futures index pulled up. So that is exactly the story. You know, you think about market highs in equities going to risk-on environments, and that typically should not be buoying up gold. But there's other catalysts that are promoting it exactly to what you mentioned. You've got lower yields ticking down, and you've got a softer dollar, which means that investors are still looking for a safe haven or store of value. And of course, the yellow metal is where the place is to be with that. Now, we did hit the previous highs here. We haven't tagged the 3,500, which it hit back like kind of in April, but it has tested this 3,400. We had a swing low coming off of it. We can see I've got the Fibonacci retracements is what these colors are, which measures essentially different support levels as we hit swing highs and swing lows. We are breaking out of the 3,400 pattern. We did it yesterday. Today is kind of a leg up on that. So we're inching towards staying into this sort of resistance zone that we have to cross. And if we can get into that, we should be tagging that 3,500 level. The big news coming into this week as well, you know, we don't have a lot of strong macro data coming in, but trade tensions are still going to take front and center stage, specifically with the United States and the EU. They have to work out a deal. If they don't, I know the EU is working on potentially retaliatory draft, targeting about $72 billion worth of U.S. goods, which covers things from cars, aircraft, bourbon whiskey, digital service, etc. So we could see how that all plays out. But it's all looking good for gold right now to break through that level and maybe retest those $3,500 highs there.
Interesting stuff there, Jay. You're taking a look at telco ETF.
I'm looking at the telcos, right? And so the sector itself has been on a bit of a run. I've got the symbol IYZ pulled up. This is the iShares, and it's a U.S. specific telecommunications ETF. Now, one of the interesting things here, the telco space has, in terms of ETFs, has seen the third most cash inflows into that sector, and it's actually has the 4th highest returns. These are out of 11 sectors across the broader economy. So the interesting things that I've found out, this is over a 3-month period. So there's been lots of money flowing in, and you know it's not just tech earnings that are coming out today. There's some big telco companies reporting this week. We have Verizon already reported early. I'm going to touch them in a second, but we've got T-Mobile, AT&T, as well as Charter Communications. They're going to round out the week on Friday.
I was going to say, we're talking U.S. telcos, right? Because in Canada, it's a different story. This ETF is not.
No, this is U.S. specific. But I do want to highlight because some of the really interesting news out of Verizon. So they saw their revenue up 5.2% year over year, but there's some really kind of a mixed bag of story coming out. They actually shed monthly wireless subscribers in terms of their wireless business, but they added almost 300,000 internet, and the market seemed to be appreciating that. But kind of the interesting news that kind of made my antenna stand up was that they raised their forward-looking guidance based on what they're calling favorable tax reform. So this is the big beautiful bill that passed through Congress and got White House sign off. But let's pulling up the charts. We can see over the last 15 months we've been on quite a bullish trend. So that's a big primary trend, really outside of everything outside of last April. And just kind of bringing up a little bit of a definition on the chart, we can see that there's been a kind of a resistance or consolidation zone in the stock around that 28.50 is where it's kind of bounced its head off of this particular ETF. But after it crossed over its own 200-day moving average kind of late in April, we can see it's been trading on quite an uptrend. Once it broke through, there's a bit of a kind of a triple bottom formation that formed that kind of catapulted the measured move out of that up into past that resistance zone, and it's now trading towards the upper end of its channel. With those bigger earnings coming later in the week, will be interesting to see if they can continue to push this particular ETF, once again U.S. focused, even higher maybe.
Key areas for our viewers to sharpen their pencils on. Now, thanks for that, gentlemen. If you at home have a question for our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the TD Active Trader platform risk-free. Just open a practice account, you click on Try TD Active Trader, that button right there. And then when you're ready to switch to a live account, you simply export your workspace and start trading for real. It is time now for Trading Debating. The stock this week in the spotlight, Chipotle Mexican Grill, a fast casual restaurant known for its customizable burritos, bowls, and fresh Mexican-inspired ingredients. Before we get going on the debate, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Now let's get back to the stock of the hour. Chipotle, other than the fact that it's food, and we seem to be on a bit of a food roll, Domino's last week, Chipotle this week, made you guys pick this one to debate.
Yeah, Greg, the theme of the quarter has been about the taco trade. So we said, that's, for those who don't know about it, it's the references the market swings from the administration vacillating on the tariff policies. So we said, let's talk about the real taco trade. In this case, of course, Mexican fare. And then, of course, in the namesake, and Chipotle, being Chipotle Mexican Grill. And I looked up an interesting stat. In fact, Mexican fare now tops all international food styles, and at least in terms of number of restaurants, so even surpassing pizza in the U.S. And generates even about $34 billion in revenue, which again is combined is more than pizza and Italian food altogether. So
now, my old job, Jay, a burrito used to be my go-to lunch at least once a week. It wasn't Chipotle. I'm not knocking Chipotle. They just weren't the closest to the BN Bloomberg building. So I just went to the one that was the closest. What made you pick this?
Well, that's part of it is Chipotle's expansioning, right? I know we've actually have a new one opening, not far from us back in our town. So that's interesting to see. But also, it's been a couple years, 18 months when they went through their 50 for 1, 1 for 50 split. So it's brought the stock into kind of affordable prices for the kind of the average investor, down from those $3,000 levels. So there's lots of people that now have the opportunity to get involved, and we're going to have a sort of debate about it, I'm sure. So, yeah.
All right. Well, let's get some time on the clock then and get into that debate. You each get your 2.5 minutes to make your case. Then we get some time for you guys to counter. And then, of course, we talk about options. As always, you draw from a hat. Jason, you are the bull. Take it away.
I'm the bull. I'm the bull on burritos, and I'm no shame in that at all. But there's an investing maxim. Follow the smart money. I know you've heard that one before, and it's referring to institutions and hedge funds, really those deep-pocketed investors. Well, there's institutionally, the average for S&P 500 companies in terms of their institutional investors is 80%. If we look at CMG, it's almost 90%. So right there's a tick in the bull column. The smart money's following there. But let's turn to Chipotle itself. They've carved out a nice little niche for themselves in that fast casual that you mentioned off the top, kind of right in between the casual dining and fast food. They've kind of been able to take over that market. But there's a few things that I think really kind of set CMG apart. One is going to be, like we discussed, is their aggressive expansion on their footprint. 315 planned new locations, and that's just the tip of the iceberg. They're currently sitting at 3,700 North American locations alone. The plan for that is to get that up to 7,000 new locations, or 7,000 total, and they're focusing on suburban environments to really spread their reach and maybe move into some more affluent communities as well. So that is a big thing. And another thing is, hey, we learned Domino's isn't in Italy. Well, from last week's debate, well, guess what? Chipotle is now expanding out into Mexico with their first planned location in 2026. And they haven't rested on just expansion of their footprint. They've embraced technology. They've been a pioneer in terms of mobile app, but they're using it as not just a way to connect with their customers, but also to generate repeat business, targeted ads, targeted promotions. So it's something they expanded on through COVID, and they've really run with it there. But they've not just left it with what's in the palm of your hand. They've actually been able to use technology to their benefit in their store locations. The one that I thought that was really cool is that I love when they come up with creative names. It's the Autocado. It's where they're actually putting a machine in their stores to cut, peel, and core avocados. A whole avocado in 26 seconds. They use 132 million pounds of avocados every year in making guac. That's 5% of the U.S. crop. So any time savings can lead to cost savings. I think that's a good thing. But let's jump ourselves into the chart here. I know we're running short on time. CMG has been on quite an bullish trend. I know lately that we've been approaching back to the trend, but it's a couple things that really jumped out at me here that really I thought allowed us to think that that these support lines are going to be holding in place. What we can see here is that around kind of the $48, $50 zone is there. We're now, with recent trading, approaching back into that. I've been able to identify kind of a doji star formation where we're seeing a big red candle followed by a small disconnected doji, along with a big green candle, which signifies typically a bullish reversal in the making.
All right. There's no such thing as an avocado pattern in technical analysis, is there?
You know what?
Not yet.
Maybe we
Google it. They're probably
they all had to start
so,
somewhere. Maybe we can. I don't know what Heron's got for us. What do you got from the bear side?
Yeah, let's talk about the bearish side, and while some people might like spice, investors might feel some heartburn with Chipotle, of course. First of all, they had same-store declines in years. It was the first record of it. And its aggressive positioning basically they might be biting off more than it can chew. So let's talk about some of the growing skepticism around it, and that's really on fundamental and some of the technical weaknesses that I'll point out to. Let's talk about competition first, though. We know the Mexican space, as I mentioned, it's more crowded than a Black Friday sale at let's say Sport Chek or Walmart. Every gas station, grocery store, and food truck now in the U.S., of course, this is more predominant where the primary store locations are, offers authentic Mexican fare, and just like Chipotle, but better, cheaper, and some would say even faster. So when you talk about their direct competition in the fast casual business or fast food business, Taco Bell, that rings, we can't go without talking about it. It's ranked the 4th top restaurant chain, according to Technomics' annual survey. They have 16.2 billion in sales. Chipotle ranks 7th in that scale at 11.2 billion. The other thing is same stores growth. That's a key metric in this business. Taco Bell came in at about 9%, according to its recent quarterly earnings report. And we know Chipotle was negative for the first time in a few years there, low single digits. Also, the guidance is low single digits comparable sales growth that they're projecting for the rest of the year. They guided down as what they have. Then we have musical chairs at the C-suite level. So their previous CEO left last August, Brian Niccol, and accepted a role at Starbucks, of course. So basically, this is like your best picture getting traded mid-season. Technically the team can still play.
Language.
Yeah, there you go.
Technically the team can still play, but try explaining that to your fans why they should be excited about that. So that's what we got to talk about. Let's go into the charts and we'll run through the charts. I got the weekly chart pulled up. I wanted to start with this because it's painting quite a story. We've seen consecutive downtrend on the long term going back to last July here. It failed to make new highs. It's making lower highs, in fact. We did see a new trend starting to buck in the intermediate side after the April lows. But get this, it's now piercing this upward trend over here, and it's actually going to break this lower low that is formed over here. So that's a key line to look at. If it breaks through here, we could see some further downward pressure that's going to come on the stock. I'm going to just make a switch to my daily chart here and just show what's happening on the daily level here. So on the daily chart, what we have is we've got a couple of things that are taking place. We've got tests of this level. The resistance is broken down below that previous resistance now.
Both guys taking it right to the wire. Well, you got 3 minutes now to bounce back and forth. You can go into the charts as much as you'd like to make your case. I will give Jay the first word.
All right, let's do this. So we mentioned competition, and in my research here, looking at Morningstar has actually classified Chipotle as having a wide moat. This is in an industry that's lots of competition. There's zero cost to switch your business over, but this has really been credited on industry-leading comparable sales, customer loyalty, and enduring brand. This is even coming out of a brand that many said was damaged for life based on food quality crises back in the 2014 to 2018 range. This is something that's been expanded into there, and if we start looking, yes, same-store sales growth might be on the low single digits, but there's really some other great comparables that put them as industry leading. There's a couple of restaurant-specific things. We've got they're only at 25 to 30% behind their high, so there's room for growth in terms of volume that they can actually fit through their stores. And they're still achieving growth in terms of their revenue. And then the second thing is we're looking at the new stores. We know they've got big expansion plans. There's something called cash-on-cash returns. The normal return from a benchmark in the industry is 8 to 12%. Well, after 2 years, this is where they're taking the amount that you've invested to open up the franchise to what you make in a year. Once again, 8 to 12 is the benchmark. Chipotle is sitting around 60% after the second year. So big business coming through, lots of dollars, lots of revenue.
Jay, let's talk about what you talked about, the food safety issue and the brand and how they got the acquisition of these loyalty customers. So as we know, they were slapped with the largest food safety fine back in 2020. That amounted to $25 million back then. Impacted about 1,100 people at that time between the 2015 to 18. Now, when you think about incidents like this, yes, it's in the past, but they do live on, especially in the food industry. Reputation is, it's like the half-life of uranium. It sticks around and glows ominously for decades to come. And this has permanently damaged its brand intangible assets. We've seen potentially slower comparable sales growth that's going to happen, elevated market expenses, and they've done this loyalty program by offering, free and discounted food to buy traffic coming into their stores as well. I wanted to talk about the store expansion because they're not going to be immune to the tariffs that we see. One of the things especially that's going to impact them is the avocados you mentioned.
It's true.
How much do they make again? 5% is sourced from the U.S., so they have to source the rest of it.
No, they're using 5% of the U.S. total
production.
crop.
Okay.
So
5% of U.S.'s total crop, but they still have to source it externally, so that cost itself is going to weigh down on it. The same store sales even were noted on one of the reports that said that Morningstar's, in fact, noted that the cost of building new stores could rise $65,000 to $75,000 a piece based on the tariffs that are going to be coming out there. So you've got these added costs, which means that those margin compressions are going to start being further compressed and pressured on that.
We chatted a little briefly when I was going through our doji pattern. I want to bring up one other pattern I've missed. Every time I see one, I need to make sure Hiran sees it. So we've seen testing the support around $48, and we've seen the downward trend. But as you can see on the chart, their trusty CNH, our cup and handle pattern, has demonstrated that we've seen the big bull with the handle falling off. If we can see the measure move out of this, it's pushing it back beyond those 52-week highs we saw earlier in the year.
Show us that pattern again. Not because I want to, along Jay's argument there. I just think that's a breedable, isn't it?
It's a breedable. It could be. Yeah. Let's.
Why can't it be a breedable? I don't know.
It can be a breedable.
These things got to start somewhere, my friends. All right. Spirited debate, spirited counter. Now, if you're taking the bull position, as Jay did, and you want to go onto the platform and look at a possible option strategy, what could it be?
All right. So what I'm thinking, one potential option that we can play this is thinking about kind of long-term growth. We're thinking about kind of allowing the stock to recover, giving it a chance to run. And kind of this is nicely kind of earmarked with the aforementioned Mexican store opening slated to be kind of late spring, early summer of 2026. Well, there might be an opportunity for us to kind of go long with some options, buying a little bit of time to give the stock a chance to recover, a chance for those reversal patterns that we pointed out earlier on the screen to really take advantage of that. So let's go jump quickly into the chart here. I happen to have some strike price information kind of plotted out on the chart so we can see exactly what we're working with. The numbers have changed just slightly with this morning's trade, but effectively we've got a measured move or an expected move based on the at-the-money straddle of a little bit over $13. If we're thinking about buying, I've got a $60 strike price that's placed in here that gives us about a 44, maybe a little bit on the higher side of that in terms of expected in the money. So we're buying a little bit away from the current price to allow us to have some cost savings. So it's going to limit the risk going into the trade, but we're not going completely far out of the money because then we're not going to be experiencing the benefit of if the stock price does go up, we're not going to be experiencing that in our premium as well. So the goal with this particular trade is buying something. I've got it out to June of 2026, buying the $60 calls, which are going to allow us to effectively use that as not quite a stock replacement because that would typically be buying something that's really deep in the money, but we are taking kind of a long-term, buy low, sell high type of experience with this particular trade, and we've got time. Right now, we can, as we get closer to expiration, the volatility will increase, but we are not going to be kind of saddling ourselves with time decay with this kind of long-term strategy. And when we're thinking about the trade, I've got it at the bottom of my screen. It's $4.35 is what it's quoting at right now. So it's affordable to kind of take this play on a long-term basis. And you have time, even if you are experiencing some near-time pullbacks, as Hiran was kind of advocating for, you still have time to be right in this particular trade with only risking $4.35 or $435 a contract.
That's the risk, because you got time to be right, but you could also be wrong.
Yeah, that's true here, but you've bought enough time. But also the other risk, it is a directional trade. So it does need to go in the way that you're banking on it to go. Otherwise, this might be something you'll need to manage a little earlier and get yourself out and cut your losses.
Okay, interesting one there. What would the bear possibly trade it?
Yeah, so if you are of the bearish opinion and you were expecting a sizable move down, one possible trade you could look at, Greg, is a bear put spread. So it's a directional trade, of course. We're speculating a move down. So I've got the chart pulled up, and this is kind of where the thesis first played out. So in this particular case, I put up the Fibonacci retracement levels, and I just wanted to see where are the key levels where we see the price sort of rejecting off of. We did see this key zone here, which is the 0.618, which is known as the golden ratio, where you've seen it tested from its lows previously and testing it a few times. So going into this earnings print, yes, it could come down to this, possibly down to the 0.5 level based on how it's currently trending. and even tag this 0.618, which is sitting right at that 50 zone, or it could do a complete move down to the 0.764 zone. So this is where the trade works. So in considering a bear put spread, I have gone a little bit in the money. So we're looking to buy a 55 strike put, which will put us right over here above the recent swing high. And then we're targeting down on the downside up to a $48 put over here. Now, this is a 7-point spread, so if I go back on the options chain, the other rationale behind this trade was, look at volatility coming into the print. It's kind of in the mid zone at 41% implied volatility. The move is expected to be roughly about, let's see what I have here, $3.72, which is a 7% implied move, which is kind of middle of the ground. So coming into this trade, we're looking to spend $3. And we're hoping to at least come down to 48. So our potential profit on this trade would be just the difference of $4 there is what we could potentially make if it does end up playing in that space.
What if you're not right?
All right, and that's the big question. What if we're not right? We've given
I like the way Hiran put his head down. Like, maybe he's not going to ask me about if I'm not right.
I thought you would, Greg. So this is why I partly chose the 55, because we want to give ourselves a little bit of room. So right now, the stock's trading at 52. So if it does even, in fact, pull through that measured move of the $3 and breaks above it, we will be out the $3. Now, we are going to the 15 August cycle. I should mention that. So we do have a couple of weeks time built into that. But if it doesn't happen, that means we're going to be out what we're going to be spending in this case, which is $3 over here. Nonetheless, you do have assignment risk on this trade. I'll mention that as well, because we're buying and we're selling a short put on the other side. This is the only risk of that is if it goes fully in the money, you could end up picking up the shares, but you've still got the put on the other side, which you could exercise. So that's another thing for viewers to keep attuned to.
All right, interesting stuff there and interesting ideas. Thanks for laying out the bull and bear cases for Chipotle Mexican Grill. Just a reminder to our viewers that the debate was for educational purposes and does not reflect our personal opinions about the stock. Now, before we move on, Jason, you want to elaborate on the earnings analyzer?
Yeah, I'm going to talk a little about the earnings analyzer. It's a really interesting tool that consolidates and brings together in an easy to use in a visual manner. Okay, so this is kind of important because we're talking about lots on the show here already. We're looking for pricing trends. We also want to find some trends in other key metrics, whether or not it's in trends of volatility, you're looking trends of like pricing data in terms of their options, or even trends from a fundamental perspective. This tool can really kind of lay it out for you, so it's kind of easy to follow and easy to kind of make hopefully some predictions of where we think is going to, what's happened in the past will maybe impact us in the future. So let's jump in to the platform and take a look. I've just got I'm on the trading tab where we can see our option chain. If you want to get to the earnings analyzer, it's on the aptly named Analyze tab at the top of the page. This is where also the same place you'd go to get those risk profiles that we use quite regularly on the platform when we're doing our own personal analysis. So from here, what we're seeing, we've got the price chart up at the top. We've got this is a really interesting chart that I like to use here just to really track. The way I like to determine is when I'm looking at the volatility perspective, how juicy are premiums. It's looking at backwards historical or delivered volatility versus implied volatility. So we can see right now heading into earnings, the IV is above the HV, so that's telling us our premiums are going to be a little bit more expensive. We get to track the pricing of the money straddle, so we get a chance to see that. Actually, going back to the volatility, the other quick thing about that is what's really nice here is I would remiss not to mention something called volatility crush, and that's something I think is really important. That this is one of the reasons I want to talk about this is that we get to see after earnings when you have your unknown events become known, the volatility you'll be able to track and see how in the past has the volatility kind of gone down and how that's going to be affecting your premium. You'll be able to use that kind of as a forward-looking expectation for future kind of volatility events going forward. But jumping back to this as well, we're pricing in the straddles. We're tracking some very key metrics in terms of revenue, earnings per share. So it's a one kind of stop shop, kind of visual place for us to track quarter over quarter how the company's performing in terms of some of their key metrics and how that is actually mapping over to the price chart as well.
All right, powerful tool. Thanks for walking us through that. If you at home have a question about the TD Active Trader platform, or if there's a stock you want to see our trader debaters here go head-to-head on, just send us an email, td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. So if you can't join us live, be sure to visit the YouTube page. You can catch up on all the previous debates. The link is right there at the top. And if you're going to do that, well, don't forget to like and subscribe. As we mentioned earlier in the show, tech stocks are going to be in focus this week when we get those earnings from Alphabet and Tesla tomorrow after the bell. The first of those so-called Magnificent Seven to report. So it's going to be pretty key, but there is a lot of companies reporting earnings this week. So we're going to highlight some of the other big names on the radar here in Intuitive Surgical. You're looking at them after the close today?
Yeah, Intuitive Surgical. So this is a company that's kind of a leading player in surgical robotics industry. It's the maker of the famous Da Vinci and Ion robotic systems. So it basically develops, produces, and markets robotic systems for assisting minimally invasive surgeries there. They've almost had a first mover advantage. They had they've installed base of 10,000 Da Vinci systems in hospitals worldwide, performing over 14 million surgeries thus far in 71 countries. So it's a pretty global presence. This market is a growing and burgeoning opportunity, looking at about mid-teen range of growth, 15% for 2024, 16% anticipated for this year. But what's interesting about Intuitive Surgical is that they're growing at about 19.1% based on the trailing 12-month revenue from a year ago, which means they're starting to take more market dominance away from that entire market space there. So coming into this earnings print, the market's expecting $1.92 on the EPS side, $2.35 billion on the revenue side, marks about 8% on the EPS side, EPS, and about 18% year-over-year growth, respectively, for revenue. Now, the other thing is, in the last 2 years, ISRG has beaten EPS 100% of the time. So it's met consensus and beaten it, in fact, and it's done 88% on the revenue side of things. So they've got a bit of history behind them coming into this earnings print. Now, what's going to be key for investors to look at with this company is the robotic procedure volume, which is key in this. What that growth is going to be, the capital equipment placement. So essentially, are they inserting more of the Da Vinci systems in different healthcare institutions? And then the gross margin trends, what that's going to be key for. Looking at the charts, though, you can see it paints quite a picture. So what I've mapped out on the charts over here, we've got this long-term weekly bull trend. It did break out of that in March. This was formed back in October 2023, which is respected. It did break through in that one. We saw the April lows, of course, and it did start a new trend over here. Now, it has reached, there's a couple of things here. There is a liquidity zone, which it's just broken or it's kind of sitting in, which is going to be a key catalyst. So it's broken below this trend that started back in April for the first time now, a clear breakthrough it. So this could mean coming into this earnings print, there's a $35.50 implied move to the upside or downside. So we're looking at either tagging back the resistance area at the 550 to 555 level or coming down to the support at the 485 to 480. So that'll be key. If we can break through that, that's kind of what might set the new trend and where it goes there.
All right, interesting one to keep an eye on before your knees get so bad that you had the Intuitive Surgical's equipment go to town. And do people ride boxcars anymore? Remember the old boxcar?
A broomstick and a bag.
You got union. I'm trying to find a segment between robots and trains.
That was smooth as it gets, right there, I'll say, for sure. So, all right, so yes, I know Intuitive Surgical and all the tech names, railroads aren't as dazzling, but when you've got news that's starting to kind of bubble up to this magnitude, it's worth kind of stopping and paying attention. We've got kind of rumors starting to build around the number 2 U.S. railroad, Union Pacific, and kind of reaching out and looking for merger potentials with the number 4 railroad, which is Norfolk Southern. These two combined would make by far and large the largest railroad. Both sides have abstained from commenting at this early stage in the game, but it's also been reported that Union Pacific has acquired an agent to help explore possibilities. And these two are, Union Pacific focused on the western half, 2/3 of the United States, Norfolk Southern more on the eastern, southeast focus. This would bring back into a nationwide player, so there's definitely some efficiencies. Now there's going to be plenty of hurdles to cross, and along with some reviews by some regulators. NSC, so Norfolk Southern, is trading up on the news, which is kind of common for acquirees, and Union Pacific is down, and that's not that uncommon, but a long and expensive track lies ahead for these two. But jumping into the chart, we've got Union Pacific, who we're focusing on. They are reporting this coming Thursday. There's been lots of mixed signals. One thing that jumps out to me here is especially over the last little bit, there's definitely been kind of range-bound trading going on with the company, but mixed signals heading to earnings. I've got on the chart there, we've got an island top that's formed, which has caused it to break down. But then just when you thought we were going to be breaking down below lower support around 220, we've got a double top forming, kind of heading us into right back into towards the top of the range. So lots of back and forth. In terms of earnings, analysts are expecting about 1.7% year-over-year increase. And after debating kind of CP earlier in the year, got a little bit of railroad knowledge need to show off. One of the big things was something that we call the operating ratio. They're looking for something below 60%.
Like golf, right? Lower the better.
Lower the better. In this particular
ratio.
case, it's Union Pacific has dropped below 60%, and that's at about a 5% drop. So really looking to see if they can continue that downward trend of creating higher efficiency and greater revenue share in their tracks.
Right, interesting ones to watch. I won't speak for you guys, but as far as my body goes, it probably needs Huron's company more than would be able to jump on a boxcar and taste the sweet freedom of riding the rails across the country. It is a nice dream, though. And maybe I'll do it tomorrow morning. I'll just jump on the other train and start heading west.
Yep.
Now, I'll show up for work. That's it for our show this week. I tell the producer, don't worry, I'll show up for work. I got a family, I got a mouths to feed. And as always, investors at home should perform their own due diligence before engaging in trading. Thanks for watching.